Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
And back we are for another weekly market recap, another late morning recording because I was busy early in the morning with what some would call actual work, like manual work, practical work. You know, standing to my girlfriend is the kind of thing that I'm not really cut out for, because she always says and reminds me that I'm better working with my brain rather than with my muscles, which, yeah, you know, well, take it for what it is. I'm a tiny, fragile little man, apparently. But, you know, jokes aside, let's have a look at what happened in markets. Of course, you know, the talk of the week was FOMC with the highly anticipated and expected rate cuts. And, you know, the market reaction to it maybe wasn't what a lot of people were expecting. But, you know, the news in and of themselves, maybe even them, they weren't what a lot of people were expecting, myself included, if you remember last week recording. Now, let's have a look at the economic calendar. We got early in the week the ADP employment change on a weekly base, which came in positive, but as you can see, maybe we are offsetting the few negative prints that we had ahead of that. And, you know, as you can read, at the end of the day, yeah, it's a little bit of a bounce in the data set, but, you know, it's really nothing to write home about. But the point was, again, still talking about the labor market, we had the job openings. Now, the data came in positive, right? And it was, I think, above expectations, maybe. Yeah, consensus was around 7.2 million. It came in at 7.6, almost 7.7. But, you know, I think this data point right here is a little bit misleading. And, you know, the thing with that is, yeah, you have a lot of jobs openings, but at the same time, and again, as we discussed last week, you don't have a lot of hiring, right? So what's going on? If you want to look at it with some sort of a rosy glasses, you might say, see, there are jobs available, right? They are there for the taking if you wish, right? But, you know, I think there is another dynamic in that. Oftentimes, you'll see companies, obviously not all of them, but, you know, a good chunk of them, they will keep on posting jobs just to see if they can actually snipe a very good employee when the time comes, right? Let's say you have a business and maybe you're fine with the workforce that you have, but yeah, you still keep an open positions just in case someone with a very good curriculum shows up. At that point, you might seize the opportunity to lock in a very good addition to your team, right? So just because there are job openings, it doesn't necessarily mean that the companies which are posting them are actually, you know, willing to fill them, right? They might get a lot of curricula getting in, and yeah, well, they just put them on the desk and don't even look at them. So, you know, that could be one thing. Another could be that, you know, if you are a publicly traded company, right? Is it or is it not in your best interest, as for the price of the stock, right, or for the to keep investors satisfied, right? Is it in your best interest to keep on posting jobs, as if, you know, business are good, and you, well, look, we are actually trying to hire someone else, someone new. Business is so good that I'm still looking for new employees to put in, right? So, you know, there is a little bit of a shady dynamic in there, which is why I think this data point right here, you should take it with a grain of salt, right? Especially because then if you keep on looking in the report and you look at the quits, right? Well, the quits are pretty low, right? 5 years low in this data set. Again, what does it mean? Well, if less people are willingly or voluntarily leaving and quitting their jobs, maybe they fear that if they quit this one, they are not going to be able to find another one. So it's another thing that for me, it's not particularly good. And on top of it, it wasn't on the calendar that I'm using, right? It wasn't posted in here, but if you check the layoffs and discharges, they are actually taking up quite substantially over the last 3, 4, 5 years, so to speak. So again, when you mix it up together, all the things, the openings, yeah, which, as we just explained, you need to take them with a grain of salt. So, well, do you really trust that? Then you see the quits, which would imply the confidence of employees to actually quit their jobs and then finding another one, a better one, a better paying one even, right? And then you look at the layoffs. Again, the labor market, to me, it's still kind of on the, danger zone side, so to speak, right? And that's basically all there was for the economic calendar, because all the rest, starting from Wednesday, was all about the Fed. So I didn't even, take the time to actually include that. Also because I think that there wasn't a lot. All right. Let's look at, since we are talking about what the Fed just said, the break-evens. So, of course, Powell talked about inflation and what the new expectations and projections are. We are going to dig a little bit deeper into it later on when we look at the bonds and the yields. But for now, just to hint at that, it looks like break-evens are still not pricing in a huge inflation danger, which again, you might listen to some Fed zombies talking, and a few of them are still worried about a potential for inflation renaissance, especially because we got the tariffs, let alone the fact that after 9 months we don't see any sign of inflation, but we still got the tariffs. So maybe in another year they could show up their ugly faces in the data. Yeah, maybe, but for now they're not. And again, I doubt if we have inflation going ahead, it's going to be because of the tariffs, right? Sure, I mean, the tariffs might cause some price spikes here and there on some specific goods, but overall, in aggregate, I think even if it happens, it's just going to be like robbing Peter to pay Paul, right? You are going to pay more for that, and if that it's something you need, right? You're going to detract disposable income from another sector of the economy. So, you still have that amount available to spend in a month or in a quarter or in a year. So if the price of something that you really need in order to survive is going to go up, you're going to subtract from, the discretionary spending, so to speak. So on aggregate, I think tariffs won't cause inflation, right? Now, sure, if you look at PC, since last week, it came up a little bit. Might be just data fluctuations. Probably. Let's have a look at the CPI, which, again, it went up. Now, I think, as we're going to see with rates, the dynamics in that, it might be driven also by expectations, all right? Now, don't forget, we are just coming off of the Black Friday week and all the rest. So it might be we had a bit more of spending right now because of the festivities, right? But I would say there is still the risk that again we have pulled forward future demand into the present, and then we are going to see a payback period. Maybe, I don't know. Again, you will need the data to confirm it, but let's put it this way: it's just an expectation, right? And then we will try to deny it or confirming it as we go. Now, it's kind of relevant to look at the Fed Watch tool right now because we just had cuts. Of course, now they're pricing in a pause, but it's still too early. You've seen last time we were looking at these how this read was volatile, right? And then at the end of the day, we had the cuts anyway. So for now, I think it's just irrelevant. We might start to weight it in a little bit more in maybe another 2 weeks, maybe, yeah, right? So we'll say GDP now, 3.6%. But, well, I mean, I actually have the data from the SIP report directly from the Fed. So we are going to look at what their estimates are for GDP for 2025 and going ahead. So again, for now, I never liked these website, for instance, so I think, take it for what it is, as usual. Credit spreads are still relatively low, so not a big issue there, right? So that would be it for the economic calendar. Let's start to have a look at some charts, and let's have a look at the currencies first. Now, this is basically what we are still looking at the euro performing particularly well. We got back into these previous, resistance now to the T for now. We'll see if we have enough fuel in the tank to press into this level right here. Pound, same thing. Although, they got a little bit of a divergence at the end of the week, maybe. No, actually, no. I mean, they were pushing up. I guess the pound, it looks like it pulled back a bit more, but it's because, it was just ahead of times and they moved to the upside. So maybe you could say, right, even if you expect these currencies to top out at this level, you might say, well, the pound went up sooner, so it's probably going to top out the first. Again, if you think this is the top for these two currencies, right? And therefore, if you think the DXY is going to rebound from here, right? It's just an assumption. But, I was just trying to explain the different behavior, essentially in the last 2 days of the week, right? Now, what else? Canadian dollar, it kept on being strong after last week. So nothing new in here. It looks like a very legitimate bounce. I mean, look at these highs. They're so clean. So I guess, didn't really see any pullback from this level right here. We chewed through it. So, I mean, it would make sense to go and take these highs now, right? The Swiss franc, stable, as expected. I mean, it's chopping around, but still in this range. It's been in here since basically August, or the end of August at this point. So nothing new under the sun. Now, Japanese yen, if you remember, it was tapping into this level, and we had a week where we saw a drawback, but after that, it put together a bounce once again, but nothing conclusive for now. Though, the best hope you could have in order to be bullish, this currency against the US dollar, would be trying, maybe to build up a base in here, and then in time trying to regain terrain a little bit. But for now, I don't see anything conclusive. If not, I was reading a good article about the yen and Japan in general. It was posted, I think, throughout this week or maybe last week. I was reading it this week anyway, by Michael Nicolaitis. I'm sure I'm going to butcher the name, but it was Michael. And it was Nicolaitis. I don't know if you pronounce it with an English accent, with a Spanish accent, whatever, but that was the man. So it was some sort of a contrarian type of article, because, at the end of the day, if you check, the debt to GDP for Japan, it's 230%, right? The BOJ holds basically more than half of the Japanese treasury's debt, and they have a demographic problem. And, as for the growth, when you adjust it for inflation over the last, 15 years, it was, very lackluster, to say the least, right? And, of course, they have a budget problem, because a lot of what they spend every year is used to service the debt. And, the yen actually plunged like 50% against the US dollar since 2012, which would be, if you go on a monthly chart, maybe, would be in here, as you can see, like quite a huge drop, right? But, the contrarian side of the article was that, since Japan it's basically holding all its own treasuries, half of them by the BOJ, the other half, it's, for the most part, is held by Japanese themselves. So they could afford to actually have higher yields and keep on servicing the debt. It's not like they risk that the foreign market will punish them, right? And again, they owe those money to themselves, right? Okay, maybe for a while, I guess it could give you a little bit more of oxygen rather than the opposite scenario. Okay. And then the other point was, well, look, you might say that a weak yen is actually bad for Japan, which I think it is, under many different perspectives. Like they import a lot of stuff from agricultural goods to food and especially energy. That's true. But, if you think about, for instance, the Japanese manufacturing, like Toyota, well, if the yen goes down in price relative to other currencies, but buying a Toyota instead of any other car manufactured elsewhere, it costs you less, right? So that should ideally boost exports for Japan and therefore bringing money in from the outside. So, is it a little bit of a dynamic where you try to devalue the currency? It's like China has done it many different times, right? And speaking of China, with the geopolitical tensions escalating, if you devalue the Japanese yen while the Chinese yuan is actually appreciating, you could try to steal market share from China, right? So, the article was along those lines. Now, I'm not saying I completely disagree. I always like a little bit of a contrarian view on things because it can help you out to stay on focus and to consider things that maybe you weren't considering. But at the end of the day, I still hold my ground here. I still think that Japan is quote unquote fucked over the long run. Although I can't deny that in the short term, these dynamics could actually play a role. Maybe not for the currency itself, if you're trading it, but for the Japanese economy and Japan as a country. Maybe it could be one last desperate attempt to make things better or whatever. So it was interesting nonetheless. So just a tiny little bit of a parenthesis right there. As for the other currencies, again, as you see, the Chinese yuan, it keeps on pushing higher against the US dollar for now. Same for the South African rand. Nothing really changing in these two. Brazilian real, still in this range. Nothing really changed in the grand scheme of things. The Australian dollar, well, this week, didn't really move a lot. Still a push to the upside, but a little bit of a pullback in the last 2 days of the week. Now, I honestly, I don't know what happened to the ruble at this point. Like up until the point we were looking at this scenario right here, I had a few reference points, a few levels, right, to go off of. I don't even know what's going on in here because I tried to zoom in, but the chart, it's just not clear. So I just don't know. It might be, again, we are hearing a lot of talks in between Russia, the US, and the tensions with Europe, or maybe a little bit of geopolitics. Now, obviously, we are talking about freezing and actually seizing, maybe permanently, Russian assets, which, in my view, it's completely bullshit. And I say it as a European. You don't do that. I don't know who had the idea, but you never do that, right? And especially now that I'm thinking about it, if it is true that you cannot do that without the US approval, since they control the system via the SWIFT and all the rest, that they control the plumbings, right? Again, if I was the US and I was hearing about Europe only thinking about doing something like that, I would just go like, well, not under my watch, because, I'm not going to undermine my own authority. I'm not going to fuck the real nuclear weapon that I have, which is basically the currency, and weaponizing the currency. Because if you do that, I think there's no coming back in the long run. If everyone sees that for the first time you're financially seizing assets of another country, and we're not talking about Iran or another banana republic. We are talking Russia, a nuclear power, right? So, I think you don't do that if you like to maintain your reserve currency status. Now, do I think that just because we or the US or Europe, whoever, just because we do it, the US dollar is going to lose a reserve currency status tomorrow morning? No, but, since basically currencies, they trade on trust at the end of the day, you wouldn't like to throw a dent in that trust, because whether you like it or not, whether you hate the US dollar, many other people hate it, but they keep on using it because there is no other alternative. If you create, right, the premises such as there is no alternative, but see, the situation now is that bad that we are going to create the alternative, even if it's, painful as fuck to change, right? So yeah, I don't know if that's a good move from the West as a whole. Now, the Indian rupee was weak. I sound like a broken record, but look at that, right? So, at the end of the day, currencies were just like that. What do I think about the DXY? We had the bounce, the macro bounce overall, because, since we started talking about it, we were still in here, all right? And it was August. So, in the macro landscape, yeah, it was a bounce, tiny bounce. Obviously, I was expecting a little bit more. And then we started to identify the potential shift in here. And it looks like it kept on drifting down after that. So we'll see what may happen. Either if we get back into this region right here, I would expect a bounce from that region. But it's like, yeah, the bounce to the upside, we had it, and then it was faded. So what now? Do we keep on staying in this range? We have defined highs at this point and defined lows. So that would be kind of the midpoint of the range. If you count it from basically here to here, right? That this is kind of the midpoint. So we'll see about that, right? Now, let's have a look at oil. Again, not a lot to say about oil. If not, you remember, I'm quoting myself now. Yeah, I'm a good fan of channels as everyone else, but for me, the swing high counts more for a structural shift in the current market structure. It looks like we came just shy of it, and we immediately sold off, getting back into the channel. I don't know. It depends who you ask. For a category of trader, you could also call it some sort of a probe, like, there was a clear and defined trend line. We probed the liquidity above it. We immediately got back into it, and the bounce was faded. So at this point, you would expect what? Well, standing by that logic, I would assume targeting the lows and keep on trading in this channel, right? To me, at the end of the day, it's just, as I always said, for months now, it's just, fundamental weakness. And again, up until the point, I don't see a changing behavior, like, a real bounce, which can actually be sustained and not being faded after 2 weeks. I will keep on maintaining this, slightly bearish view on oil. I'm going to say again what I said many months ago. I think before going up substantially and sustainably, this market needs to trade lower. I would say in the 50s, right? Then we'll see. Can I be wrong on this? Yeah, absolutely. I can be wrong on many different things, but it's not showing strength whatsoever. And every time it does, it lasts for so long. And then we get back to the usual drifting, slow grind to the downside. And to me, that's weakness. So up until the point that doesn't change, I'm going to keep on being bearish oil, right? Let's have a look at gold. Okay, so gold was interesting for two things, right? First of all, we were looking at this pattern right here. It was looking like reaccumulation. So we said, okay, maybe it's going to take a while, a few weeks, maybe a month, whatever. But if it keeps on going like this, probably we are going to target the highs once more. Like, so at the end of the day, it looks like we didn't make new highs, at least on the futures, right? But there was a nice expansion to the upside. So it was interesting because there was this reaccumulation formation, but it was also interesting because we didn't take the highs so far. I think from here on out, what's going to be in the short term. No, so first of all, I want to see if after this rejection, can we, hold this region we just reclaimed in here, and then again maybe sloppy, choppy, like in this segment right here, but trying to retest the highs once again, and this time presumably breaking them, or is this just the market actually setting up a range for the medium term, so to speak, and we're going to see gold falling back and, maybe, I don't know, bouncing in here, first and foremost, and then after the bounce, keep on getting back to the lows, right? And from here, bouncing up again, but overall staying in this range from here, essentially, to here, right? So this huge range right here. Could this be? Well, I guess it's too early to tell. I'm just trying to formulate a hypothesis, and then we'll see. I keep on being slightly bullish tilted because, of course, it's kind of the same with oil, right? Just the opposite, right? Turn it upside down, because it looks like in this case, right, every time it drops, they just pick it up. So it looks like there is never a period where you can have a drop in the price of gold which can be sustained. So, again, I think it's fair to say, take the logic applied to oil and just apply it to gold, but in reverse. And you get to the point where, well, maybe, statistically, if I want to play the odds, I might better be bullish tilted rather than bearish tilted. So buy pullbacks, buy dips instead of selling rips. Again, not saying the short term selling rips won't work, right? Especially, when the market goes like this, right? I mean, if you are selling the highs of this range in here, well, you're doing well intraday, I guess. But, since we are looking at things from a daily perspective, I think, buying dips, it's much more beneficial, right? Let's move. Oh, well, before moving, just because it was in the news once again, it looks like, again, it is kind of funny. Every time we press the highs, right? So it looks like, again, China, it's ramping up the reserves on gold, which is kind of the same type of assessment I gave a month and a half, maybe 2 months ago, when we were talking about the reason behind the huge surge in gold in 2025. I mean, I get it. They might buy it. Central banks all over the world are actually increasing their holdings of gold. Sure. My objection is always the same. Instead of showing me the chart measured in billions of dollars, right? Just do it in tons, like you're doing here, right? Show me the change measured in tons. I mean, this is actually trillions. Right? So, okay. But I would like to see, the weight, the tons. How many tons are they buying, right? Because if you tell me, well, I mean, the notional value of their holdings went up. Yeah, okay, I get it. And we are talking about what? From 2010 to 2015? Okay, but, I mean, but what was gold in 2010? Right? It was below 1,000, right? So we are about 4,000 now. So obviously these chart moved to the upside, of course. Now, sure, the fact that they increase the amount of actual gold they have actually contributed to it, but I think it's misleading. I would define it some sort of a chart crime, if you wish. All right. It's like when they show up, China is selling treasuries. Yeah. And then you show the notional value in US dollars. Sure. But rates went from basically 0 to 5.5%. So what do you think is going to happen to those long-term holdings they had, right? So maybe they didn't sold that much. It's just a chart looking like that because of the price, price variation, right? So again, just a tiny little parenthesis on gold. Let's move to Bitcoin now. Well, again, Bitcoin so far, I guess it's the least surprising market in between those I follow, because again, it's just behaving like I was anticipating 2 weeks ago, I guess. Chopping around, drawing back the huge leg to the downside. We are still wrestling with this level, which provided the rejection at the very beginning of December. We tapped back into it once again. And then, on Monday, Tuesday, we just dropped off of it. But, at the same time, didn't make new lows yet. We'll see. So it looks like what? Your normal, leg down, draws back, leg down, draws back, leg down, draws back a little bit more. But it is also true that, this is a tiny leg down. So the drawback, it's shorter in time, right? Then there is a little bit, of a bigger markdown, and the drawback, it lasts a bit more. Then there is a huge markdown, so maybe the drawback is going to last even more. So am I saying it's going to go down from here? I think it's too early to tell. I would just assume up until the point we stay in this sort of wedge, there is still hope. At the same time, up until the point we are below this level right here, can't be really bullish on it. Okay. Then if we can reclaim this level here, we might have, as we stated, the potential to, expand these bounce into this region. But we're not there yet. So, you trade what you see, and the market is always right. So yeah, it's nice to build up a case, and if these, then that scenarios, but up until the point they don't unfold, they're not actually actionable. So for me, it is what it is, a choppy market, which is slowly trying to get back into balance. And after that, we will see what comes out of it. I'm not, even if you're massively bearish on Bitcoin, right? Given the fact that it started to trade a hell of a lot like traditional markets, I wouldn't expect it to go down like 40, 50% in a month. I think if it keeps on going down, it's going to be as low distribution, as low melassa movement like this one right here. Sure, from time to time, I think you're going to have this mark down, right? Which is basically when the market is actually giving in on a very relevant level, like it was in here, for instance, okay? But, I think those periods where you see the market either going up or down for weeks at a time, I'm not saying they're over, but they might be, a bit more rare compared to what they were in the past, right? So that would be it for me. And again, for now, bearish up until the point we can reclaim this level, neutral up until the point we don't break out of this wedge and, basically show intentions to keep on going down. So we'll see about that, right? Now let's move into the talk of the week, right? Now, obviously, everyone was waiting for Powell to come out of the closet and saying something relevant for markets. And, let's start out with these, which, the usual dot plot. Now, I guess for me personally, this just leaves the times it deserve, right? I don't really believe that shit, to put it bluntly. It's just, they're going to revise these scatter chart whenever they see fit, right? It is just a clue on the potential expectations for the members at the Fed. And bear in mind, we are start to seeing dissent, even in, among the Fed members, the FMC members. So, this time around, we got 3 dissents, I guess. Sure, Miran, he wanted to cut 50 basis points, but other two, I guess they were, in favor of keeping rates unchanged. And the rest of the committee was for a 25 basis points cut. Now, I think, skipping this because, I guess the majority of people don't really understand that. And, total honesty, me too, all right? But let's transition into something which is much closer to what the average person could actually comprehend, which is this, the SIP, so the Summary of Economic Projections. So in a nutshell, this is what they said, right, in the press conference, which, to be fair, I didn't watch this time around because I was out for dinner when it came out, because usually, 2:30 p.m. in the US, it's like, 8:30 here, so I was already having dinner. But they said these, so they forecast GDP growth from 1.8 to 2.3. Interesting. Which is why, again, do you remember every single time I shit on this website right here? Do you remember I was saying what? Probably around 2%, if you are lucky, 2.2, 2.3. So, I wasn't making these numbers up. It's just, it looks like a bunch of PhDs are actually agreeing on that, which makes me think now, because usually they're always wrong in the long run. So am I wrong? Am I just falling victim of the group mentality? Well, maybe. We'll see. I mean, on this one, I guess I would be a bit more confident in saying that I expect GDP to be around 2%. But, there's always that margin of error. What they said, again, PCE, they actually lowered inflation expectations for 2026. Although, guess what? I mean, 10 basis points, something like it. So, not a lot, it looks like. 2027. So they think they are going to be back to 2% in 2027. Really? I mean, it can be, right? But I guess it depends, right? It depends. Unless you have some sort of disruption in the real economy, maybe we could drag out this higher than expected inflation, or higher than the target inflation, for another year. I think there are many different things which could actually completely invalidate these theses at point number 3, but again, they're not unfolding themselves yet, so we gotta wait. Unemployment rate is peaked in their view, but again, we were looking at the JOLTS right at the beginning of the video. So is it peaked? Hopefully. I mean, you gotta believe it's peaked, because otherwise there is no bueno for the real economy, right? Let alone financial markets, but for the average Joes and Janes, I don't think it's gonna be good if they're wrong on this one. They are expecting what? The Fed funds range for next year in between 2.1, 3.9. Well, thanks. That sounds very precise. 2.1, 3.9. Almost 200 basis points of a range there. Sure. Yeah, okay. Right. And then what? Longer run GDP remained at 1.8%. This is interesting. They don't expect AI and the massive data center build up to actually add to productivity and, benefiting the economy. I think it is controversial a little bit. Yeah, maybe, like, if we don't see this build out, obviously not, because up until the point it's just, that circular type of economy in between the Mach 7. Then I would agree. But what if we figure out that we actually don't have the capacity when it comes down to energy production to sustain this build out? And you start to reassess, well, should I completely renew the power grid? Should I invest a hell of a lot in infrastructure? Well, for that, you need actual workers. I mean, that would create jobs. So, I mean, it would benefit the economy in a sense. So I don't know. Although, again, we are not seeing it yet in practical terms. So, we will need to wait. But without all the mambo jambos and the nonsense we just spent 10 minutes talking about, let's get to what the market was really, interested in, which is, surprise, surprise, although the screenshot is really blurred. I'm going to read it to you. The committee judges that reserves balances have declined to ample levels and will initiate purchases of short-term treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. Which, for those of you which are not particularly familiar with the Fed jargon, it is QE. All right? Look, they're going to tell you, and I've seen people already, just the other day, that was a very good friend of mine, we talk basically every day, was posting an extract from a blog his friend is writing, right? And he was saying, well, again, same tone at this statement right here. Well, we are just maintaining the level of liquidity and bank reserves in order to make sure that we don't run into a crisis. So, it's just a tactical operation, but we are not really getting back to... Look, you're buying up treasuries, you're impacting the amount of liquidity in the system. That is QE. There's no other way around it, right? And it resonates a lot with 2019, if you remember that. Kind of the same plot, really. We got a little bit of a problem in the repo market, kind of like what we had last month, right? And what they did, they immediately started to buy up treasuries. They say it's to maintain the level of liquidity, which, mechanically I could agree with that. Like, it doesn't change a lot for you and me, like real people, but for the banking system, it might, if you assume that bank reserves are actually money, which I don't, because I think the way they're expecting it to play out is, well, if we purchase the treasuries and we give the banks more reserves, they can use those reserves to settle transactions in between themselves inside the banking system. That should keep, the fear and the risk at bay. Yeah, in the banking system for sure. Although for the real economy, I can only use a bank reserve as, as the term would suggest, as a reserve. Like in case I need money, I can still go to the, to reverse the process, right? I got the reserve, I get back to the Fed. Look, here you reserve back. Give me back my treasury because that's what I need, all right? But would you think if the economy is going south, and maybe you need some sort of a bridge loan for whatever, for your company, and the company is not posting very good results, right? Do you think a bank would actually lend you money just because they got more reserves? Or would they assess the counterparty risk and deciding, well, you know what? I would like to lend you money. Actually, I have the balance sheet capacity for it, but I don't want it. I'm not going to do that because you're just too much of a risk for me. So again, I think you do this shit to boost up confidence at the end of the day. And most likely, and it's not me saying that, it was Bernanke back in 2008 to say that they were performing QE in order to boost up asset prices, in order to boost up confidence and sentiment so that people in the real economy would feel better and keep on spending and therefore being the catalyst for the economy to recover. If you go and read the actual transcripts from the FOMC and the statements they had in front of Congress, this is what Bernanke said. That's the magic behind QE. There is no secret sauce. It's all a psyop at the end of the day. So that's what the market was interested in my view. 40 billions a month, as far as I read, but they didn't specify, the implementation of that. So we just have kind of the target, short-term treasury securities, and the amount, but we will see the implementation and what will it be. Just remembering 2019, or what Yellen did back in the days, I just see one big risk in it. Like if you assume, and it would, in my view, it would be a safe assumption. But if you assume that the banking system and the repo market is all running on collateral, and the best form, the more pristine form of collateral which is used, it is actually treasury bills, so very short-term debt. Now you would assume that the banking system actually needs that. If you go out and basically seize all the supply of that, don't you take the chance of subtracting the collateral from the system right when the system needs it the most? Or am I completely out of my mind here? I guess time will tell. And, obviously, if someone has a different opinion or could explain better why it won't ever happen, again, because it would be the second time after what Yellen did. But if everyone thinks it differently, well, hit me up in the comments. I'm all open to suggestions. So besides, after all of that, let's have a look at what, you wouldn't expect yields to go up, right? We are implementing QE. We just stopped QT at the beginning of December, and right 2 weeks after that, so 10 days, 2 weeks after that, we actually announced QE. So why would you think rates actually go up? Isn't it strange that the market is reacting basically the opposite of what you would expect, especially the medium and long end of the curve, right? Yeah. And actually, if you look at that, I mean, you got both in the long end and in the 10 years, got a shoulder here, a head here, another shoulder here, kind of a defined trend line, neckline in here. Could these be, they just triggered, a rally in yield? Don't make mistake. If you check back in time, what happened, the first 2 or 3 times they implemented QE after the 2008 crisis, well, when they started it, yields went up. Although QE was designed to suppress yields and rates, right? And just when they ended it, yields plummeted down. Like, all right, okay, does it work as intended? I don't know. Now, I think, there would be a good chunk of people which are going to tell you, well, it wasn't as expected, a very hawkish type of cut. It was actually dovish because you are basically announcing QE, so therefore more accommodative monetary policy. So maybe, longer rates are going up because people expect it to be, stimulative of growth and therefore inflation. Okay, maybe I could, the knee-jerk reaction from markets could be that. Absolutely. I think, ahead of the meeting, we got these huge moves, which is not unusual. You tend to see them. And then on the news itself, you had, well, that was Wednesday, this one right here. So a little bit of a sell-off. I mean, in yields, it would be more of a bounce in the actual treasuries. So, it's not something which is uncommon. Although, I got to be honest here, at the end of the day, no matter all the speculations and trying to analyze all the different views, I got to call it spade to spade. I'm not particularly confident in judging what bonds and yields are doing right now in the very short term. Now, if you ask me, what do you think is going to happen next week? I honestly don't know, right? Because, if you check the long bond, it looks like it hit back into support. The problem is that I don't like to see a sharp move like this getting into support right after we had a massive spike to the upside, because the inefficient move which could be filled in after we hit support has been already rebalanced. So, out of the bat, I don't like it. Let's say if I had to buy in here, right? But, at the same time, doesn't necessarily mean that you're not going to see a bounce from here, right? Structurally, it would make sense. It's just that it doesn't leave me confident in judging one way or the other. It's one of those times where I would say, you know what? It's fine not having an opinion. It's fine not having a position. Not having a position is actually a position. So, yeah, I think just wait and see, especially because if I remember correctly, we're going to have a lot of economic data coming in next week. Let me check. I mean, we're going to have Miran talking, so more dovishness, but then what we're going to have, I mean, non-farm payrolls, both for November and, the late data from October, I would expect, right? Retail sales, all the labor market data, so unemployment rate. This is just on Tuesday, I guess. Wow. And then we're going to have what? Well, housing market, not really relevant for what we look at. Retail sales, and then what? I thought there was inflation somewhere. There you go, CPI, core CPI. So, I mean, there is a bunch of stuff coming in next week. So I would wait a tiny bit to reassess this market, maybe next week, right? So that's where I stand. As for the result or the interpretation of what came out of the press conference and the meeting and this rate cut, and my basically inability to judge the market reaction. It is strange. This is one of the few times where I'm speechless, I don't know, right? But if anything, right? If you really want to hang on to something, again, it looks like we're in for a bounce in yields, right? And therefore maybe not so bullish for bonds in the short term. But guess we'll see. So let's move on and let's have a look at the last segment of the video for the week. How can you end up a weekly recap without including, of course, the equity market? Which again, it seemed fine up until Friday, basically. Now, we have seen the stock market, if you consider that we are just judging the index at the end of the day, so we don't have, by doing so, we don't have a clear insight in what the different sectors are doing. But just for the sake of it, every single time this week, every time the US markets were opening up for the New York session, the market was dropping. And then, of course, you had a little bit of a rebound later in the session. Again, this pattern went on up until Friday, where we had a much more sustained type of down move. Overall, the week ended up a bit on the meh side. A few sectors actually held up better than others, especially if you consider finance or services to the consumer right here. But, technology was hit. I think the majority of it was because of what Oracle said. I think it was Oracle, right? They said that, that they're seeing some sort of a slowing pace in the data center build out. But then again, it was another one of those statements which were completely, backpedaled upon, right? A few hours later. It's just that this time around, instead of being like last week with Microsoft, this time around, the market kept on dropping. I do believe, on a macro scale, we should now be out of that mutual fund distribution type of window. So, if there is a moment to shine for the stock market, it should be this one. Although, again, it was choppy, to say the least, over the last 2 weeks. So at least we got that. Now, the week started out like this. Let me have a look. Is it the right Monday? Yeah. So we started out on Monday and we immediately dropped, basically. Again, overnight, London session was kind of stable and then we dropped. And we pulled back toward the end of the session for Monday. Same pattern on a Tuesday, as you can see, Asian session, stable. The London session was wishy-washy, and then we dropped at the beginning of the New York session again. This time around, we stayed around the lows. You might say, well, maybe a little bit about the risking activity ahead of the FOMC meeting, which was on Wednesday. And then when we got the rate cuts, the market just skyrocketed higher. Yeah, and it lasted for how long? basically in the Asian session, we were below the daily lows, right? Compared to the rate cut announcement in here. So yeah, again, Thursday was just crazy shit. Like, you know, massively up in London, New York opened up. We went down a lot, and then up to, you know, basically the highs for the week, just again to drop down starting on Friday. So, you know, when you zoom out and you look at these, you clearly see that it might be there's still a little bit of a rotation going on, because at the end of the day, like ES futures, they held up relatively well. Like they deviated ahead of this range in here to the upside, and they fall back into it toward the lows, as you can see. NQ futures were much weaker than that. I mean, I get this candle right here, but when you see weakness after a candle which, you know, try to hang in there, I mean, it's not super cool. And again, I tend to believe that you cannot really have a sustained stock market rally if you don't have the Nasdaq leading, or at least, you know, that was the pattern over the last 15, 20 years. So, you know, I'm always a bit skeptical for upside when I see NQ struggling. Although again, it doesn't really mean that after these, you know, another one of these rotations, we finally see the market getting its footing and try, you know, to move higher. It doesn't look that good for now if you look at it, but you gotta look at that in the context of the entirety of the month of December at the end of the day, right? Again, usual caveats, just because there is seasonality, just because you hear people talking about a Santa rally, it is just statistics, right? Doesn't necessarily mean that it's going to happen for sure every single year. Otherwise, it wouldn't be statistics. It would be a certainty. And there are no certainties, right? And again, I often talked about rotations, well, because at the end of the day, if you look, for instance, at the Dow, well, the Dow performed relatively well this week. The Russell performed well. Why, you might say? Well, of course, but because, you know, small caps are much more, you know, sensitive to rates. So, you know, if you got a rate cut, they should respond better than the rest. Nonetheless, they had a little bit of a sell-off on a Friday, giving back, you know, as for the Russell, kind of half of the gain of this recent pump. As for the Dow, well, not really a half, but, you know, a good portion of that. Now, before we move on, I would just say this, which is probably it's not going to be relevant for the short term, but maybe, you know, for next year, just, you know, just a thought. We have seen, as I just hinted at, the tech sector being the leader when it comes down, you know, to providing upside for the last 15 years, right? What if at a point we get into a situation where there is a market rotation, but on a much bigger time scale? I'm talking about months, if not years, where you're going to see that flip in the perennial debate about what would you put in your portfolio, growth or value? And for the longest time, growth vastly overperformed and outperformed value. So what if we get into a period where we have a much higher market volatility, a little bit more of uncertainty? We have been looking at the valuations for a long time now. If I can just mute my phone at this point, although, you know, we are also at the end of the video, but better later than never. What was I saying? Yeah, well, look, if valuations become a problem, if volatility tends to be a little bit higher historically, well then, you know, maybe people would bet on something with stronger fundamentals rather than, you know, the shiny things under the sun, waiting for returns which are promised today, but they might be delivered 5, 10 years from now. Like this thing you see with AI. Look, I totally believe AI is going to be, you know, the driving theme for the future. But the problem is always expectations, right? And sometimes when I really zoom out, it looks to me like these markets are pricing in, or gosh, let's delete that. These markets are pricing in the AI revolution as if it has to happen next year. And, what if instead it happens in another 5 or 10 years before, you can actually monetize these AI investments, right? So moving that goalpost, like from 1 year to the next, it actually changes a lot, which again, it ties in with what we've seen right on Friday with Oracle. It takes just a hint of the fact that, well, maybe those milestones and all the rest that we were planning to reach next year, well, maybe we have to reassess, and maybe it's going to be 2027, and the market drops, right? Because it's so overextended that it just takes a tiny little thing to miss out on expectations, right? So, just a thought, right? And if you want to be defensive, I think might be the time. I mean, if you embrace this vision, I'm not saying it's going to happen for sure, obviously, but it's just another one thing to consider. And if you embrace it, or at least you feel the risk of that happening, might be the time to start on trim your positions on highly beta stocks and starting to add, boring, low beta, low volatility, but maybe, high dividends paying type of stocks, just to balance out some risks, right? Now, after that, at the end of the day, what we're looking at is, I mean, it was in the cards, right? You remember that, choppy, potentially a little bit of a pullback toward that cluster of moving averages. I think I'm on the record saying that, maybe 2 weeks ago or the last week, but it was not of the cards. A little bit of a pullback and weakness, because the premise was choppiness, potential weakness with mutual fund distributions, right? So I guess it's not completely invalidated. When I say that, I mean the potential for end of the year rally. If you look at the very short-term moving averages, so the blue and the yellow, I think we are in that period. It was confirmed, I guess, in here, right? Where you should start to discard them a little bit because, well, moving averages, they're especially very fast moving averages. They're good in a trending environment, but when you get stuck into a consolidation like these, those very short-term signals are often, faded or they are fake out. So, just remember the tools you're using and the conditions under which they are best, the best tool for the job and when they start to lose efficacy, right? Also, we saw the stochastic actually turning down on this move. The MACD didn't trigger a sell signal yet, but it's close, especially on NQ. So what if, best case scenario, if you want to keep on being bullish, we hold this region right here. So for NQ would be 25K, just to pick a psychological rounded number, right? For the S&P might be, well, basically where is that now? 6,800, 6,700, more or less. This region right here, right? We do chop around for another few sessions. We give in this case, it could be the stochastic, the time to cool down a bit more. Potentially, I'm going to pick this one just for the sake of it. Well, actually, I can pick them both. Potentially getting back into the 65s, something like it, just holding the bullish control zone, and then, trying to push again higher, right? That would kind of be the scenario if you want to keep on being bullish. Of course, the opposite is, well, if we keep on dropping, we might revisit the low side of the range at that point, which obviously, it would throw a dent in the entire narrative of the Santa rally. Or at the very least, you could say, well, so, if the Santa rally starts from a much lower point on the map, maybe it's not going to bring us to new all-time highs before year end, but we might end up the year basically where we are right now. So imagine, for instance, the S&P dropping, and then you have the Santa rally, but it just gets you back in here where you started the drop for now. So it's another possibility, obviously, and therefore, new market-generated informations are coming in, and you need to reassess. I don't think the setup I was talking about is completely negated yet. Might be close to be negated, but it's not yet, right? And, other than that, I guess it's time to be nimble a little bit and just, don't overreact and don't panic, whatever, right? That would be it. Now, let's have a look instead, as usual, at a few slides. So it's nice. I mean, it's nice. Let's say it's interesting that this drop, especially on NQ on a Friday, came in right when, as we were looking at last week, we got the bearish sentiment actually going down, right? So strange, right? A little bit of a counter indication, if you wish. Another thing would be, and although I guess this is a bit more, it's not as interesting, but it's just a testimony of what we've seen these last 1-2 years, more or less, which is this. Again, the retail investors, which are overperforming, right? They're overperforming not only the institutionals and the pros, but they are overperforming the market itself when it comes down to the index, right? Does it speak to the exuberance of the market? Maybe a little bit. And you know that at a point exuberance has to fade, but this is what happened. Okay. Now, the other thing might be that, look, not only we had, you remember we were talking about the breadth of the market, and with this recent consolidation, right, like the breadth actually improved a little bit, but again, we are not at levels you would like to see when the market is actually trending to the upside in a very sustained way, okay? So again, improved, but yet it's not where you want it to be. Hopefully, if you're bullish, you're going to see it moving in a very positive zone in the next 2 weeks. But if it doesn't happen now, at a point that there must be a little bit of a time component on it. It's like when you put on a trade. Sure, you're going to have your points of invalidation and levels on the chart, or maybe the indicator turning red or crossing up, down, whatever. But, from time to time, even time plays a role. And I guess, we are running out of time for this setup to unfold itself. So again, just another thing to consider. And obviously, this is a little bit more in the bearish camp, I think. It's like, professional managers, they always buy the tops. You wake up one morning and you discover that basically all the pros are like Michael Saylor on Bitcoin, right? But I guess, it is funny to say, obviously, but I do also think that these guys are not trading like you and me. So, they buy on confirmation. They need to assess the risk first because they got career risk. And they can stay underwater if they want for a long period of time, if they are betting on the long run, right? So let's take one silly example, for instance. It could be recent, possibly. But as you can see in here, right? The market is bullish, right? This is 2023, yeah. The market is bullish. It breaks out after this consolidation and drawback in 2022. The market breaks out. They buy the top, sure, but market pulls back and then it keeps on going, right? They buy the top, once again, short-term top, and then it keeps on going. Now again, they buy this top, the market pulls back and then it keeps on going. So to some degree, I think they are not strictly trading like I would, and maybe not even you, right? But, this is just the way it is. Sure, if you take the data for what it is, it looks like when you have a buying spree from these people, the market suffers a little bit. So, yeah, that's the statistical relevance of these. Now, I mean, this is a little bit harder to read because I took the screenshot, but I didn't notice that the resolution was shit. But it's kind of a little bit of a follow-up to that chart we were looking at for the consecutive monthly advances, right? I mean, if you can read the numbers, I guess, make with them what you wish. At this point, since we are exceeding the 6 and 7 months consecutive advances, I would start, to lift the pedal from the metal a little bit with this one, just because we don't have enough sample sizes. But, I guess these are still numbers. So if you want to play them, this is it, right? And you also got the source if you want to retrieve a better screenshot of that. Now, there's one thing in these markets, and again, we hinted at that many times in the past, which is margin debt. Now, I'm sure a lot of you knows, but maybe someone doesn't. So just to fill in the endings for this video, I'm gonna briefly talk about it. Look, basically, when you think about opening up a position, right? You can do it if you got your savings, like you have your job, you save a few money every single month, and at a point you have enough, and you say, you know what, I'm gonna invest this thing so that they're not gonna lose against inflation by keeping them in my checking account. Sure, all right. It is fine up until the point the majority of the inflows in markets are coming from savings, right? But there is a point where they are coming off of debt. Basically, you loan money, and then with that money, you invest in whatever you like. That's basically margin debt. Now, the problem is that when you borrow, did I say loan before? Yeah, you borrow the money, okay? The problem when you borrow, you have interest, right? So usually they are, those are lent out to you at a prime rate plus 2%. Now, the prime rate at this stage should be what? 6%, if I'm not mistaken. So again, you got that debt, you're paying interest. So how much does the market need to return you in order to make that margin debt profitable for you, right? Because if the market is not moving and it's not going anywhere, at a point, you're going to be underwater. And so, if there is no more convenience in keeping this margin debt up, because you're actually losing money because the market is not moving in your favor, you're going to do what? Unwind the transaction. You're going to sell the assets you bought, and you're going to pay back the loan you took out, which brings to what? Price in the market going down, right? So this is one thing, right? And if you check where we are right now, I mean, we are not really at nose bleeding levels, but, sure enough, we came up. And again, I think it ties in very well with the everything bubble or with the K-shaped economy, whatever. When the economy sucks, you just turn your eyes to the stock market casino in order to, try to improve your current conditions. Now, here you have a few historical reference to what happened when, margin debt, the balances of that actually went particularly higher. Again, we are not in the danger zone per se yet, but we are approaching it, quickly enough, right? So just be prepared is another risk to put on your bingo card. And here you have the same relationship. I mean, this is basically the amount of exposure, right, that the household has in relation to the equity market as a percentage of financial assets. So as you can see, when basically everyone bought, usually the market had a little bit of a downturn. And again, the market is near the highs. And this right here, the household equity ownership, it's particularly high. So these would be another good risk. Now, That, again, it's like any other thing. It's like valuations. Doesn't mean that because it's high right now, the market has to crash tomorrow. Probably not, okay? But it is something which, if the market actually has a downturn, it could exacerbate the downturn, both in terms of speed and magnitude. It's like a deleveraging event. And this, again, is the margin debt as a percentage of real disposable personal income. So what does it mean? Look, it means that, again, you have a job, so you have an income, and out of that income, you're going to cut the taxes that you have to pay on it, and then you're going to cut the fixed expenses that you have. So all which is left, it's your disposable income, right? Now, if that disposable income, it's eaten up more and more by the amount of money that you put in your margin debt account, you will reach into a point where you don't have enough income to keep on fueling that margin debt. And again, when you come to that point, what happens if the market just stalls or it pulls back? So again, do you remember the beginning of the slides? You don't have the incentive to keep on maintaining the margin debt because it's actually costing you money instead of returning you money. So what's going to happen, right? And again, a few other historical references to what happened when these reached into very high levels or percentages in this case. At the end of the day, the problem is that, this is the relationship from basically this chart right here and, the movement in the stock market. Does it mean the market is going to crash tomorrow? Probably not, right? But sure, it adds to the risk that you're taking. Again, you need to take note of the divergence there. Like on one hand, I'm trying to analyze the risks. On the other hand, I follow the price. So just because I know there is a risk out there, that doesn't mean that I'm selling everything today. Now, I'm not talking about me personally, but I'm talking about, the logic, the methodology behind it. So that when you actually see price unfolding a potential downturn or risk in the market, then when you have your technical trigger, if it is sustained by fundamentals reasons, which add on fuel to the fire of risks, perception, knee-jerk reaction and panic, you know that, like with the tariffs, right? You don't have, right, to wait for the market to be down 25% in order to say, I'm going to the risk, right? That's the name of the game. Be aware of the potential risks, but at the same time, waiting for the market to confirm. Because if you simply go off of, oh, well, but this could happen. Oh, well, that could happen. Yeah, these could be disruptive. Sure. And then what? And then what if the market keeps on going higher for the next 3 years and you never got back in because you were scared of this or that happening? This is the problem. I mean, there is no other way around. Either you're in or you're out. Now, you can manage the amount of exposure that you have, right? But it's not like you can be completely in and out because you think you can time these things perfectly. There is always a component of risk involved. But again, as they said, no risk, no return, no pain, no gain, right? So if you want to play this game, just make peace with this simple fact. There is one prevailing truth in markets. Whether you're investing or day trading like I do, the only thing for sure is that you're going to lose money. Even if you have a winning strategy, the one thing for sure is that you're going to lose money sooner or later. Even if you have a 99% win rate, yeah, well, sure. Congrats, kudos. Still, there is that 1% where you lose money, so that's the only thing for sure. Because if you invert the entire logic, you're losing money in the 99% of the times, and you're only making money in the 1%. So again, you are losing money. Just to say that over time, you can make money over time, and that's an unknown, right? But you most definitely gonna lose money from time to time, and that's a certainty. So again, if you don't like the rules, don't play the game, right? And with that, a little bit of a reality check maybe, let's end up the video for this week. Now, by looking at the calendar, I see that next week is going to be what, the 20th. Well, we got another chance to talk before Christmas, so I'll save the wishes for later. And I'm just going to wish you for now a good rest of your weekend and a good start of next week. And as usual, be nice and be cool. Nils out.
So, what you're telling me is that the music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.